In this video, we will talk about John Paulson and his $15 billion trade shorting the housing market. John Paulson is a hedge fund manager who has been running his hedge fund for more than 20 years. He did his MBA from Harvard Business School and then joined the investment banks and learned how to do merger arbitrages. In 2000, he was doing merger arbitrages. He had no idea about the real estate market. Paolo Pellegrini is an Italian who has also done MBA from the Harvard Business School. He also joined the investment banks. He's almost close to 50 years, but he has not had a successful career. He is without a job and he has been through two divorces and needs money. And he now looking for dreaming to make a good trade that can make him a lot of money so he can go for retirement. He is without a job, so he contacts John Paulson for a job. And John Paulson offers him a very low-level market research job, so that mostly 25, 30 years old people do market research and gone on leave. So Paolo Pellegrini is, has no job, so he accepts that job. And he looks around for opportunities, and in the year 2000, 2001, and they realized that the US housing market is a big bubble that can implode any time. US housing market mortgage backed securities were very popular in those days, and many investment banks were pulling the mortgage backed securities. 1,000 securities into large pools and dividing them into tranches. The most risky mortgages at the highest interest rate, but they had also the highest risk, means they had high chance of default. And these mortgage-backed securities were being sold all over the world, in Europe, Japan, South Korea. All the banks are going crazy about these mortgage-backed securities. They want to know that they are very safe securities. Paolo Pellegrini does the research, and he is convinced that this housing market is a big bubble that will implode, and if they can short this housing market, they can make big money. So he goes to John Paulson and convinces him that this housing market is a big opportunity. Now, John Paulson has never done any investment in real estate before, so he tells Paolo Pellegrini to do more research. Paolo Pellegrini is a very meticulous man, and he takes the data for the last 10, 20 years of the housing market, does the regression analysis, and he comes to the startling conclusion that the housing prices are at their peak and they can collapse more than 30 to 40%. So he goes to John Paulson, convinces him that there's a big opportunity, and if their timing is right, they can make big money. And the best way is to take credit default swaps and collateralized debt obligations on these mortgage-backed securities and APX index. APX index tracks 20 subprime mortgage securities. Credit default swaps is a type of insurance that you take on the debt. For example, if I take $100 million loan, and if you think that I'm going to default at the loan, you can take a credit default swap on my $100 million loan. You just need to make annual premium, make payments of annual premium as long as you want that insurance. And in case I don't default, then you lose your premiums. But in case if I default, then the seller of these credit default swap CDS is bound to pay you $100 million. Anybody can buy credit default swaps on someone else's debt. That is very interesting. So they decide to buy credit default swaps on these mortgage-backed securities. Now, in the mortgage-backed securities, there's a huge demand for the subprime mortgage because there's a huge section in the U.S. that cannot afford these mortgage-backed security mortgages, so they are known as subprime. So banks, they just decide that these we will give loans to them. And since these mortgage-backed securities are bought all over the world, so they will just transfer the risk to those parties. Now they start giving mortgages to persons who can't even buy their own TV set, not have regular jobs. They just give them $200,000 mortgage loan, 300,000 mortgage loan, and just like that. And everybody is assured that the housing prices are going to rise, so they can refinance, and this party can continue in the future. So once they start going to the investment banks to buy these credit default swaps, so the investment banks laugh at John Paulson and Paolo Pellegrini, and they say that you have to lose your money because their risk models are telling them that the housing prices cannot go down. It's not very difficult housing prices to go down. And they happily they sell them these credit default swaps because they are very sure that the housing prices are not going to collapse. These credit default swap premiums it will be a source of income for them. This is very important. The banks are very sure that the housing price is not going to collapse. So they are selling these credit default swaps to John Paulson and Paolo Pellegrini. And John Paulson and Paolo Pellegrini are very sure that house prices are going to collapse. Banks, they are saying that we have got very sophisticated quantitative risk models that is tell us that very little chance that housing prices are going to collapse, and they are selling these mortgage-backed securities as if they are fail-safe. So now this is something to understand, that John Paulson and Paolo Pellegrini, they are convinced, they have done thorough research, they have used common sense, that subprime mortgage now is total 30% of the market. And they know that these people cannot, they don't have regular jobs, they can't even afford to buy a TV set, so how they can buy a $200,000 or $300,000 house. They are convinced that this market is going to implode. And they are also convinced that the banks they're selling these credit default swaps also going to lose big time. Now the point is that in the past also people have judged that some market is too extreme, but the timing was wrong and they lost or not. So John Paulson knows that the timing is very important. He should be. So he slowly builds his position at default swaps, and in 2000, late 2006 and beginning 2007, the cracks start appearing and the prices start falling. And these default swaps, they are not profitable. For the last 2 years, the default swaps were not profitable. They were a loss, but now they are profitable, and he is a $2 billion profit. And investors, they tell him that you should take profit, cover your position, because the market is going to reward any time. At that time, John Paulson is convinced that this mortgage-backed securities are going to go way down to zero. So he refuses to cover his position. This is very important. In trading also, and to take profit. If you take profit too early, you are leaving a lot of profit on the table. Now, this is what John Paulson does. He is convinced that this mortgage-backed securities are going to go a lot more, so he refuses. His investors, they implore him he should cover his positions and just take profit 2.5 billion dollars. I said no, we should wait. Instead, he also buys these collateralized debt obligations on big banks like Lehman Brothers, Bear Stearns, because he knows these banks they have a lot of mortgage-backed securities on their balance sheets, and then they are going to implode also. So he waits, and then, as he had anticipated, it happens exactly like that. The housing market collapses, and with that, the mortgage-backed securities they default, and with that, these big banks also go bankrupt, and he makes a lot of money. Ultimately, he made something like $15 billion out of his $4 billion for his own personal take. And Paulo Pellegrini also succeeds in making more than $150 million. So I hope you like this video, and this is a very good case study